Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. We are recording this on Thursday, the 7th of May, and I'm delighted to be joined here by Kristina Hooper, who is Global Market Strategist for Man Group. Welcome, Kristina. Thanks for joining us here.
Ethan, thanks so much for having me. It's a pleasure to be here.
Well, Kristina and I both have a lot of slides on the topics that we typically cycle through. So we're going to have a interesting format this time, which will be a little bit about my lens and then pair with Kristina's lens. And we will be looking at some of the different ways to visualize the topics that we talk through. So with no further ado, let me bring up the slides. Well, I've called this podcast When Hormuz Hath No Fury. As we speak today, we are in a state where the Operation Epic Fury has seemed to be in pause, and we seem to be moving into a new phase of Operation Freedom. And Hormuz has obviously been very much at the top of all lips recently as we think about the geopolitical situation unfolding there and its impact on prices and on the region as well as on trading partners. So that is some liberty taken with Shakespeare and with that title. As usual, in every week's podcast, we cycle through the five lenses of inflation, interest rates, equity markets, geopolitics, and other asset classes. Here's Kristina, and she is, as I mentioned, Chief Market Strategist at Man Group, previously at Global Market Strategist at Invesco, and previously at Alliance, and clearly highly qualified for all of these commentaries, as we've frequently seen her on media. So let's start, Kristina, with inflation. So some of the topics I've been referring to in inflation over recent weeks has been this kind of slow decline that has just started to misbehave, in the words of the Fed. We know that clearly oil futures and oil prices are tightly tied to expectations around Hormuz developments. And then the other interesting point we've seen is a bit of divergence on a global stage when we look at expectations, say, around in Europe versus, say, Japan, whereas Japan seems to be anchored in its recent deflationary past. So lower expectations there in Japan. And then when it comes to the Central Bank of Europe, higher expectations now as they become exposed to the potential for rate rises. So some of the inflation slides that you're looking at, I know, or have a slightly different lens. Can you take us through how you're seeing the inflation transition today?
Sure. Well, I just believe that inflation is a bigger risk than some are viewing it today. We do have that recent past experience where central banks waited too long to act. And so hopefully that is something that is guiding them towards being very, very careful and thoughtful about this situation. So I shared with you this because I think there is a disconnect, or at least a pretty significant divergence between what I'll call paper oil and physical oil. So yes, we've seen oil futures actually relatively tame given the severity of the situation. But if we were to look at actual physical oil prices, they've been very high. At one point, got near 150 Brent for Brent oil, and so I think we have to recognize that this is a serious situation, and that typically the rule of thumb is that for every day of energy supply chain disruption, we're likely to see 3 days that are needed for recovery. So if this crisis were to end today, it would probably take until about November to truly normalize. So there are some significant risks. Now, if it truly is short term, if it ends soon, then the issue isn't so much persistent higher inflation, um, it, but it would be affordability and the kind of pressure that's being exerted on a lot of consumers. Now, if this lasts longer and if prices remain elevated, let's say, for example, Iran is able to control the Straits of Hormuz and can actually charge a toll. Fewer tankers can go through. We still have some sort of conflict with them, which slows down the number of tankers that make it through. Then we could see elevated oil prices for a long time. And keep in mind, it's not just oil, it's other commodities as well. So to me, that's an environment where we see persistently higher prices. And that's particularly dangerous for the US because we weren't at target before this crisis started. We were well above the Fed's target. I think the ECB is comfortable. It's in a better place in that inflation was essentially at target when this crisis began.
And it's really interesting that you mentioned this, just this, I suppose, this pent-up inflationary pressure, not just in oil. That date you mentioned, November, is of course a key one because that's when the midterms come. So if we still have high sticker prices of gas at the midterm, that will be certainly an election issue. That is a clear kitchen table issue. But also, if, as you're suggesting, this is quite wide in terms of the impact, and also that there is very little in terms of a relief valve for consumers if pressure is rising. There is, I suppose, some opinion that there is an overall deflationary kind of a norm in markets today, and this is a temporary blip. It seems that you see some of the inflationary pressures as outweighing some of the deflationary pressures currently.
Yeah, absolutely. I think there's just a lot of important commodities that are critical to the global economy that pass through the Strait of Hormuz, and so we have to recognize that's not just going to have an impact on oil and costs for companies vis-a-vis energy, because it's also a natural gas issue. But you also have the very real potential to disrupt the supply chain for semiconductors with helium. We're already seeing scarcity there. There've already been more demand than supply because of the AI data center build out. And then, of course, we also have the impact on fertilizer, which then impacts food prices. So the longer this lasts, the more potential, of course, it has to be very problematic. And then we also didn't ask ourselves what happens if we see destruction of energy infrastructure such that the build back takes a lot longer to get to normal. So I do worry that we're not necessarily, that it's not being properly calculated, the risks by markets. I think there's too much of an inclination to look at it through the lens of tariffs and think that this is a unilateral decision that the US can decide when to go in and when to pull out. But I think this is a lot more complicated, problematic, and is definitely not unilateral.
That's a fascinating point, I think, around control. And I suppose this lever of control, whether that's something that is in the hands of the president and that can be manipulated as in that way. And let's hold that thought on tariffs because that did certainly raise its head over the course of this week. Just cycling before we get into a broader a check on the on what we're seeing in terms of the economic vibes. I think it is important to touch on borrowing. Haven't seen much Fed news this week, but it is notable that Man Group has a significant presence in the UK. I sit in the UK. UK long-term borrowing costs hitting their highest level since 1998. Not a marker point that many like to look back to. And we have seen that if we compare gilts to other, say, government bonds, like in the US, like in Germany, everybody has seen a gap out in their yields 30-year over the course of the war, but none more so than the UK. And as I said, that 28-year mark is very notable. How do you see if the bond market is seen as a barometer of sentiment, and this movement that we're seeing in treasuries, first of all, over the last few days, and what does that say about expectations? But in particular, what does the gilt movement say about expectations?
Well, that's a great question. And I think the bond market tells us so many different things. It's a reflection of fear, but it's also a reflection of perceptions around fiscal sustainability. And so we have seen this departure really since around that trust moment several years ago, where UK gilt yields have been higher on the long end than other major economies, even though other government bond yields are in economies where there is more government debt as a percentage of GDP than the UK. So I think that there was some trust lost with that failed budget that sent gilt yields up and really never brought them fully down to where they were in terms of their relationship to other long-term government bond yields. But having said that, again, this is, as you pointed out, a phenomenon that many other developed countries are experiencing. And I think it goes to bond vigilantism.
Mm-hmm.
There is growing skepticism around government's ability, whether it's the UK, whether it's France, whether it's the US, to rein in spending and forth a path set forth on a path of fiscal sustainability. There is absolutely nothing, for example, that the US is doing that should give any confidence to bond owners that it is looking to be fiscally sustainable. We heard that Doge saved no money. It may have cost money. We're seeing enormous expenditures in terms of defense spending. The asks for $1 billion ballroom. The list goes on and on. There's just not that kind of fiscal prudence that we saw in the late 1990s when the U.S. successfully cut spending with a bipartisan committee and actually delivered budget surpluses for several quarters. I'm old enough to remember that. There were attempts even in the early 2010s to rein in spending, and there was some success with that. There's not even an attempt this time. So I think we're in a very, very different environment. Countries spent a lot during the pandemic. Understandably, they needed to provide fiscal stimulus, and I'm not going to second guess that. But now is a time when you're not in a recession to get one's fiscal house in order so you're prepared for the next crisis. And a number of countries aren't doing that. Now, Japan is a unique case because it has lagged other economies in terms of seeing any inflation, right? Its bigger issue was the absence of inflation, and it's an economy that hasn't seen the growth that they'd like to have seen over the last several decades. So we're seeing a lot of interest in fiscal spending. That is really the plan of Takaishi, and I think of it as Abenomics 2.0 on steroids. And that's also being met with some skepticism as well. So we're in an environment where there's concern about debt, and with good reason.
Well, it's a fascinating question. And I think it echoes a little bit what we spoke about before in terms of factors that are within control or not within control. And we've to mention the Bank of England in this, it was mentioned in the headline in terms of whether it will raise rates 2 or 3 times to counter the inflation threat. Because there is a narrative that's circulating currently that is that markets and investors are behaving as they do because in a way it's almost like that question, what would you do if you knew you could not fail or you believed you could not fail? Because if you believed that the government institutions would step up and avert disaster. And here, in fact, we have the specter of the government institution not stepping up to avoid disaster, but being impossible to act otherwise in terms of needing to raise rates. So I suppose it is that question of whether there will be a benevolent central bank, or whether the new central bank under a new chair will be less inclined to be benevolent and less inclined to step in. I know we have had a change of the guard, or change of the guard is certainly on the topic. Do you see Fed policy as changing notably?
I don't, certainly not in the near term, because you have a number of members of the Fed that are clearly concerned about inflation. They have the specter of, what happened in the 1970s, and again, the mistakes that were made in the pandemic, not acting quickly enough. So I think, the vast majority of voting members of the FOMC will stick to their guns. I think the market expectations have now changed, and no rate cuts are expected this year. And I think that's right. And I do think we run the risk of being in a more stagflationary environment where we actually see a rate hike. That might be the next move by the Fed.
Well, let's move now to some of the economic vibes. And this is very much a moving target as we've had continue to hear about job losses. And that seems to be on the doomsayer, say, ledger in terms of we've seen it not just in the US, with Coinbase cutting 14% of its staff, another Jack Dorsey style memo coming out about complete restructuring, culling of org charts, and stripping out of middle management layers. We've seen Nissan cut 10% of its European workforce. On the other hand, we're all focused on the job numbers on Friday. We don't yet know these as we record, but there are some suggestion that the labor market's picking up. So a little bit of a fog there. And then when it comes to consumer spending, in terms of the picture there for the consumer side, we've spoken about how consumer sentiment, as expressed by the Michigan survey, is at an all-time low. And then this classic K-shape expenditure in terms of the lower income earners, we know that they're not spending as much. And then how is this being reflected in the stock market sectors? That we see that the discretionary index is up its own K, forming its own K shape here, with the consumer staples index that might reflect more of the lower end spender being quite flatlining. So I know that you have some thoughts on the consumer and their spending patterns, and I will take you to the three of your slides here as you speak. So can you tell us about your thinking around this consumer state right now?
Sure, it's very much in sync with what you're talking about. This is a K-shaped economy when it comes to income, and it is the high-income consumers that are driving retail sales. I often get the question around consumer sentiment. We saw in April it hit an all-time low. And many scratch their heads and say, how is that possible if we are seeing retail sales holding up rather well, or doing fine? And I think it's because when it comes to consumer sentiment polling, it's one person, one vote. But when it comes to retail sales, it's all about the dollar spent. And you can see a small portion of American households are doing a lot of the discretionary spending. And so it creates an environment in which it's certainly positive for retailers, because they are, at least those that are catering to higher income consumers, they're benefiting from it. But is it sustainable? When you rely on the top 10% of earners to help drive the economy, my question is, how long can that last? And I just share with you, for amusement, some people might even recognize what this box is, but it's actually a photo of the $100 chicken nuggets with caviar that were being sold at the US Open and selling like hotcakes. And I think it speaks to the environment we're in, where those with money are spending it, and spending it in some cases quite extravagantly, while many others are facing a real affordability crisis.
And I didn't bring in the headline about some of Disney's numbers that's showing the very strong spending on parks, and just some of they're clearly getting more expensive. The ticket price has been more expensive, but there is a segment that seems somewhat immune to that. And I suppose the natural fallout from this K-shaped economy, and I was in Asia this week and spoke there. There seems to be a K-shaped economy emerging around the world. It's more extreme in some circumstances than others. But do you worry about that, the longer term potential for it to create instability, to drive politics, and then to drive policy?
Oh, absolutely. I think the economist Thomas Piketty has explored this topic in detail, and I think he's right in saying we very much run the risk of threatening democracy when you have such significant wealth inequality. It just, in my opinion, it can be unsustainable for a variety of reasons. And for those who think that the economy will chug along as it has, just because we have high income consumers still spending, I think we have to question whether or not that thesis really works in the long run. And actually, if you turn to the next slide, you can see just how dramatic the change has been in over just a few decades. So what I just did was juxtapose the share of households, the top 5% and the bottom 20% in terms of how much income they've produced over time. And you can see, or how much income they've gained over time, excuse me. And what you can see is that the lowest quintile has a much smaller share. The lowest 20% has much smaller share of income than it had 5 decades ago, and vice versa for the top 5%. And again, that to me looks like an imbalance.
And I think we've spoken about a K shape, but tell us about the P shape, yet another letter that we need to think about in terms of visualizing this disparity.
So the P shape refers to wealth inequality as opposed to income inequality. That means the top has everything. And the bottom, 50% and more, have very little. Quite often, they have very little exposure to the stock market. They may not be able to afford to own a house, so they have very little in the way of assets. And keep in mind, in America, the path to wealth and the way one funds their retirement is typically through owning a house and having it appreciate over time, and owning stocks and having them appreciate over time. So more and more of American households don't have exposure to those, but they do have exposure to debt, and their debt is growing. So this looks at net wealth, and you can see that the top 10% have fared extremely well in the last several decades. They're holding most of the wealth, less of the debt, than, for example, the bottom 50%, for whom there's been very, very little progress in these 5 decades. So that's concerning because, again, that speaks to inequality, that speaks to unsustainability, because many assets are income producing. If you own homes that you rent out, you derive income. If you own stocks, you get dividend income. If you have cash money in bonds, you're going to get income. So that increases the income inequality. If we were factoring in all kinds of income, including passive, it means that there is very little in the way of safety nets for so many households. And that's why you'll see surveys asking people, would you be able to afford a $1,000 emergency? And many say no. A good portion say they would have to file for bankruptcy if they were to have some kind of surprise expense. And many, unfortunately, do. So this is in many respects, a very difficult environment, one in which I would argue there need to be changes for the U.S. to become a healthier economy.
I think this is really important as we look at what could drive a sell-off, because clearly if nobody is looking to cash in their stocks and shares to make that emergency purchase, if they can essentially allow it to be compounding and have more of a long-term view, that might explain the ongoing resilience in markets despite some of these uncertainties that we've seen. I know that there is clearly the stock market sell-off could have vulnerability for the higher income consumer, as could white collar job losses, which is why I got back to that job market situation. Although for now we seem to have somewhat averted that. Just in terms of some of the other drivers moving to equity markets now. So some of the slides I've spoken to for a few weeks now have been just the resilience of earnings. We saw that come through again with the large cap tech stocks and their staggering growth of, say, cloud revenue, etc. We know that profit margins are close to their all-time high, so pointing to strong corporate resilience in terms of their ability to maintain their prices and to push through. And then the interesting point is that this America's war has very much, in terms of sentiment around the stock market, seemed to be Europe's problem, which is a little bit rough for Europe. That has not been difficult to catch a break in terms of its equity market. We see that the volatility has been higher in Europe than the stocks, say, than in the US, and that they've seen a divergence in MSCI Europe and the MSCI US stocks. Whether that's US becoming more like a safety trade or not, what is going on here as you see it, that the US remains resilient? And as you speak, I can even point to some other slides talking to that. But Europe seems to be bearing the brunt of jitters.
So I think you hit the nail on the head. I think there's a component of this that's really being driven by a safety trade. But I think if we were to look at the underpinnings of the safety trade, some of it is that tech is perceived as defensive, as non-cyclical, as less reliant, for example, on the price of oil or less impacted by the price of oil. Now, again, I think that's not factoring in the bigger picture around the potential for scarcity of components for the semiconductor supply chain, et cetera. But for now, the conventional wisdom for markets is that the US looks more attractive. Um, that, of course, could easily change, in my opinion. And in fact, part of it is that earnings really haven't been downwardly revised in the US. And if we were to go back to 2022 and Russia's invasion of Ukraine, what we saw is that it actually took several months for earnings to be downwardly revised. So I would argue we're likely in some kind of a lag period where we probably will start to see some downward revisions as we move into June, and certainly July. And that may alter the perception of US stocks.
I want to bring up one of your slides here, which discusses US exceptionalism and seeks I think, explain why we may be seeing this run into US assets. And the headline here is US assets benefiting from US safe haven status and US exceptionalism. I had to just load that slide there, showing that in a risk-off environment, treasuries have historically been perceived as a safe haven. Is that what's going on here? That it is back to the old mindset around which side would you rather be on when it comes to a military conflict?
Well, I think it's a bit more complicated that in than that in that the US is an oil exporting country, or at least marginally oil exporting. It's certainly become it's no longer dependent on oil imports. That has changed a lot since the 1970s when the US really had a very difficult period of time because of OPEC and the kind of oil shortages that were experienced by the global economy. So I think there's some of that. I think there's this negative halo around Europe because it's viewed as oil importing, and so it has some disadvantages. The reality, though, is that when oil prices go up, they go up everywhere. And so unless there's actual shortages, there's likely to be less of a differentiation or huge issues in the US versus Europe. But I do believe markets make sort of snap decisions. The quote from Benjamin Graham about markets in the short term being a voting machine and in the longer term being a weighing machine always sticks with me when I look at market reactions like this.
Well, I think we were looking at a really very interesting additional market reactions because there's been a spate of news flow. Just on the one hand, you mentioned seeing the just this kind of knee-jerk reactions markets are displaying. And we know that the chip market, I've showed many slides in the past around just how the semiconductor index, how much that has increased. We've seen that now played out on a smaller stage in terms of just the movement in Samsung. I think that has gone. I think quintupling is the phrase that I've seen in terms of it moving to a record high. That is very much on the back of the same sentiment that has pushed Nasdaq and the S&P to fresh highs. And on the same token, we have meme-like behavior when it comes to areas like GameStop offering to buy eBay at a valuation that is many multiples of its own valuation. I put up just a reminder for 2021, just to remind just perhaps how GameStop got this 9 billion of cash on its balance sheet and how it too was once a meme stock. And we've seen discussions around OpenAI and Anthropic in ventures to buy service firms and consulting outfits. So that's been another large ticket item out there around AI. So quite a lot of news flow and exuberant buying, I'd say, going on in the current market. How do you make sense of this and where investors are? Are they buying first, asking questions later? Or do they know something we don't?
Well, I just think that markets go through periods of different psychological moods. Before the Middle East conflict began, what we saw was a whodunit playing out, a reverse whodunit, where there was a lot of concern that AI was going to ruin different industries and sectors. And so we knew that the killer was AI. We didn't know who the victims were. And we were playing this guessing game where on a given day you'd see software stocks sell off, for example. And so there was less euphoria in markets. And then for the first month of the war in the Middle East, what we saw was in general, no matter what stock market it was, going down. And then at the end of March, something changed, and we started to see almost a euphoria set in. I would argue that at least some of it has to do with earnings season and attention turning to what happened in the first quarter and all the positives, especially around AI. But we're really just going through different psychological market moods, and we'll see how long this lasts. Again, I think it will last until we start to see some downward earnings revisions.
And I think it is important to put this into a broader context. This is the last slide, and it's a little bit around anxiety therapy, because some of these issues like the dwindling consumer sentiment, the persistent inflation, the K-shaped economy, these are not new issues. They've been around for some time, and there's been an anxiety, I think, at play, as well as this desire of FOMO, not to be out of equity markets because it's perceived that bonds have been quite less valued. So there's a desire not to be out of the action and missing, which is a sense of anxiety. This, of course, has been, I suppose, been beneficial for traders because they've been able to, as one headline suggests, spinning the anxiety into gold, because it has led to more trading. We've seen Bitcoin, seeing flows turn positive again. So again, more risk on perhaps in that sense. And on the other hand, as I mentioned, bonds looking less attractive. We have the ongoing, I suppose, slow burn of this private credit question mark in terms of the redemption pressure, a suggestion now that some of the markups don't make sense in some of the retail evergreen funds, and that there's lack understanding. So quite a bit of therapy if investors are on the couch here, there might be quite a bit to contend with. How do you see some of these question marks maybe manifesting in markets? Will it mean that investors want to kind of crowd in to, as you mentioned, the technology safety trade, or are they willing to spread their wings a little?
Well, I think it will result in some crowding for at least a period of time. But in my opinion, market psychology is like the weather in Dallas. And you don't have to get sick of it because before long it will change. And so I would anticipate that we will see, continued rotations. There will be something that investors are very excited about, and there will emerge risks that make them run from particular industries or sectors or assets. At the end of the day, though, I think it's so important if one has a long-term time horizon to just remain very well diversified, not get spooked. To a certain extent, you have to have blinders on. You have to know what's going on, but not let it affect your decisions because markets are so unpredictable, and we just don't know how investors will react. We don't know how markets will move on a given day.
Well, thank you so much, Kristina. That has been a whistle-stop tour through markets, not only markets behavior, but their emotions, the ups and downs. And as the headline of this suggests, we are having a bit of a roller coaster week in terms of this Operation Epic Fury being, at least for now, suspended, still dealing with the ramifications of what we've dealt with previously in terms of higher oil prices. But us all waiting now on employment numbers, trying to get some other indicators as to what's happening this week. So a lot to contend with. But thank you so much for coming here and sharing your insights with us.
Thank you for having me.
And thank you, everyone, for listening to this week's Markets Happy Hour podcast.